Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
There have been some others along the way. You could probably call this slight little bump here. Look at the Asian financial crisis. Part of that long-term capital management, again, money coming home and hiding in the U.S. And it did, again, was another boost for the dollar. But as we look further down, we look in here, and really the major improvement we've seen since this blip up in here is, of course, the credit crunch, and that's what this box shows. The beginning of the credit crunch was right here, and in fact, the U.S. current account started to improve before the credit crunch became noticed in the world in a big way. That slight improvement in the U.S. current account, again, is part and parcel to some of the money coming out of the global economy, which tend to intensify the credit crunch. But you can see once the credit crunch hit, the U.S. consumer went into a shell. Money came back to the U.S. dollar-based credit in a big way, and this is why the Fed had to put out major swap lines to all the central banks in the world to keep the banking system of the world afloat, because all of this credit was flowing back to the U.S. So what did we got? We got a credit crunch before we got the U.S. stock market crash, led to a U.S. recession, The question right here is, in our mind, and this is a biggie, and we wrote about it in our monthly piece today, is this idea of popping of the Chinese bubble. We went through the kind of the eerie parallels here between what went on in Japan and what's going on in China. Also, during this period back here in Japan, what I failed to mention is the fact that the Japanese yen started appreciating because of the fact that right in here is when the G5, what became known as the G5, got together back then with the Plaza Accord and decided they want to push the value of the dollar down and the value of the Japanese yen up. They were really trying to punish the Japanese because the Japanese were blowing and going and taking over the world in the mid-'80s, if you remember. So they're the major capital credit superpower growth dynamic in the world. So that increasing Japanese yen was, and also the U.S. demand coming out, dollar-based credit coming out of the world, all led to the popping of the bubble in Japan. Flash forward here, we have a very unique set of circumstances, a little different trigger, obviously, but an eerie similarity in that now we have China as the credit superpower in the world that looks like they're going to take over the world again, as Japan looked like they were going to do back then. Obviously, there's a difference in dynamics, difference in structure, size, and everything else in China, so the analogy isn't perfectly tight. But I think it's something that we have to be wide open to happening. So this credit crunch, the U.S. consumer went in the shell, dollar-based credit rushed home, and initially we saw just a crushing of exports, of the export sector all over Asia because of this improvement in the U.S. current account. And it's put a lot of pressure on China, and that's why the government has come in and put about a third to a half of its GDP. They've pumped in reserves back into their economy because it was lost right here from the U.S. economy and this improvement of the current account. We've since seen it turn down a bit. Now, part of our dollar story is this trigger here was a big turnaround for the U.S. dollar and change the dynamics. This trigger here takes a lot of U.S. dollar supply out of the market, and we think, we still do, that this is a structural change, a multi-year change, and not a cyclical change in the attitudes toward private leverage for the U.S. consumer. So we can see this improvement in the current account being sustained at least, and actually we had forecast it would actually go positive before this whole process was over, positive on this and positive on the possibility of rebalancing of global trade a bit, on China rebalancing its economy and looking more into its domestic sector. We don't have time to go into all that, but this is a big trigger that we saw for the improvement in the U.S. dollar long term. Second point was yield differential. We had seen the yield differential in the U.S. dollar, and I should have had the chart in here, but I forgot to pop it on, and I just thought of it. If you go take a look at the yield differential between the U.S. dollar on a 6-month basis compared to German 6-month yields, and if you want this chart, just send me an email and I'll fire it off to you. It's quite telling. The U.S. dollar index tracks that differential very, very tightly. And part of our theme has been that the U.S. Fed was going to hike sooner and faster than the European Central Bank. Actually, that's still part of our story, but of late, that story is deteriorating a bit because of the yields falling again in the U.S. on a short term, and the Fed signaling that the market's weak and they may stay on hold forever again. At least that's the expectation. So that has changed a bit also. So this is a part of our story that's a little bit in trouble here. But we can't underestimate the ability for Europe to disappoint, especially given the mess that they have over there. So a systemic risk we think is going to rear its ugly head in Europe, and I think, again, change the dynamics of the way people look at the European Central Bank. We think ultimately if what happens the way we think it is here after this rally in the euro, we think the ECB is going to have to go into quantitative easing mode in a very big way. And again, the expectations in the short-term yield dynamics we think will change in favor of the dollar. What we have here is just the yield curve, just to show you the relative yields, which are a very important part of the currency equation. The red line here is the Eurozone. The black line is the U.S. Yield curve here. And it's just showing, on the short-term end, the U.S. rates are lower than the Eurozone rates. And part of our story is that the Fed's going to hike faster and push that above, giving the dollar positive yield support. Again, that's a little bit in question in here, and I'll get to some of those reasons when I wrap this up as to why this dynamic has changed. Also, just want to show you U.S.-Japan. Japan is in the red, U.S. in the black. So even on the short-term rates, the U.S. now is approaching Japan, and who would have thunk it a couple years ago we would have been in Japan territory on the short-term interest rates. Japan is really in the soup with deflation and problems on the credit side and demographics. We don't think that the Bank of Japan is going to hike for a very, very long time, so we definitely think this spread's going to move in favor of the U.S. dollar, no matter how long it takes for the Fed to hike. We just don't see Japan getting out of the soup for a long term and long time, and that's why we didn't see the dollar as staying or maintaining its role as the carry trade currency. There was a lot of talk of the dollar being the carry trade currency when it was falling in the last half of 2009, and it was going to fall back and make new lows again. We didn't believe it because we thought that the U.S. was going to grow faster than both the Eurozone and Japan. So looks like a question here. What's on the x-axis? On the x-axis here is time, and this is a yield curve. 1 month time frame, 6 month, 9-year, 15-year, 20-year. So we're looking at bonds out here, and we're looking at short-term paper in here, and just shows the yield along it, and this is what creates the yield curve. Here is the interest yield on the y-axis. Thank you for that question. So y-axis yield, x-axis is time. So you see an upsloping yield curve, which is good for banks, by the way. Helps them liquefy themselves and make money. Because they can lend long and borrow short, and that's why the yield curve is steep by design.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.